I'm Howie Lim. This is Money Hacks by the Business Times. Over the last decade, the concept of US exceptionalism has been rarely questioned. The superior long-term returns that US stocks have delivered relative to non-US peers. But it comes at a price, and so far, investors have been willing to pay for it. Is there truly no alternative to US markets? And what should retail investors look out for? Welcome to Money Hacks, a podcast series by the Business Times, where we explore useful financial tips to help you on your money managing and wealth growing journey. I'm Howie Lim, and helping us out today, Mahesh Sethuraman, CEO of Saxo Singapore, and Rahul Ghosh, Portfolio Specialist, Global Equity at Rowe Price.
Thanks for having me. In finance or in markets in general, when people have talked about US exceptionalism, what they've really been implying is that, especially over the last, call it 5 to 6 years, US equity market exceptionalism, i.e. outperformance of US equities, indices, stocks, etc., significantly over the rest of the world, which has really been driven by a very strong US economy, big investments in tech and R&D and AI, etc. And what that really referred to was almost like there was really no need to think about investing outside of the US because US assets were so exceptional.
It's a question that we've been asking every decade. There's always a time where we ask this question. The fact that we've been asking it every decade for a long time, at least since the Second World War, we've been asking this, tells me that it is real. As someone who's been in the markets for so long, as someone who's heavily invested in the US markets, I can tell you it's real. Now, what does it mean? That's where it gets a little tricky because different people define it slightly differently. But broadly, the fact that US as an economy has been the most dominant economic force since at least the late 1800s and continues to be so, gives it certain inherent advantages in economic growth, in future-proofing themselves, in insulating themselves from the vagaries of the rest of the world, and so on.
That's Mahesh Sethuraman, CEO of Saxo Singapore, who also feels the term exists. And why we keep revisiting it as often as we do is because of the factors of production: land, labor, capital, and entrepreneurship. The US has inherent advantages in all of that and has the sheer size of a continent. But that's been true for a long time. What's changed?
Right now, it's on the back of the trade war. Even within the longer timeline of US exceptionalism, if you look at the post-80s dominance of US, particularly US stock markets, right now, US GDP is about 1/4 of the world. If you look at any global indices, US equities are about 60 to 70%. The MSCI Global World Index has about 65% exposure to US equities. That tells you that even as the contribution to the world GDP is coming down, but in financial world, they still dominate in a way that no other single economy dominates. Post-80s, when US started outsourcing a lot of the low-value production to China and the rest of the world, it basically created a difference between the GDP growth and the stock market growth. Their profit margins went up, while at the same time, a lot of people were left behind by that kind of skewed technological growth as against the manufacturing growth.
I think there's a few things happening, and we can probably separate the tariffs and the tweets from some of the other areas. What was the base of US equity market dominance? It was really US tech, the Mag 7, the last decade. They have grown earnings at significantly ahead of the rest of the market. So they really drove what is happening there. This administration has introduced some questions. If you just look at global tech dominance, while no one is saying that US tech is not going to be globally dominant, there are other alternatives, especially after the launch of DeepSeek AI in February earlier this year. The fact that you have competition from China and other areas coming up in a more resource-constrained environment gave people the sense that perhaps the unquestioned dominance of US technology should be questioned. What is also done is, US technology dominance has been essentially based on continued investment into GPUs, just more capex. Every quarter, every year, the hyperscalers and everyone else just spends more money. Again, what DeepSeek and other LLMs are starting to do is to show you that there are lower cost options, which means perhaps the diffusion of AI technology around the world could actually be happening at lower cost without necessarily only spending on NVIDIA GPUs, etc. The other thing that I think has also been happening is that till now, the rest of the world, especially areas like Europe, were pretty much still very tight on their purse strings as compared to the US, where there was still fairly substantial fiscal support and a supportive monetary policy. Now, whether it's Germany talking about releasing their debt brake, One could argue that the US administration's pressure on countries globally to spend more on defense, NATO, Japan, etc., you're seeing these countries move up their fiscal expenditure. What that then means is you do get this trickle-down effect, whether it's through banks, of a monetary stimulus into other economies. And so the US is no longer alone in being that country providing a substantially supportive fiscal and monetary backdrop.
That's Rahul Ghosh from Rowe Price. So investors are increasingly questioning their exposure to US assets. Is American exceptionalism merely experiencing a setback, or is it coming to an end?
Is a tweet going to determine whether or not the price or a tariff will be up more than one expects? In that planning, I think people start thinking about needing to diversify. So I want to be very clear that I'm not necessarily talking about de-dollarization, but I'm just talking about people think about having an alternative. That does imply that there has been and will be some selling pressure on the dollar, which is probably largely behind the weakness that we've seen on a year-to-date basis. In a strange way, investors should really just be doing more of what we always do. And they always say there's no free lunch in investing. The only free lunch is diversification. Investors have to remember that there is, and probably the first time in a long time, investable alternatives outside of the US.
Oh, nuts. I was kind of hoping for a free lunch. Still to come, while record US stock prices suggest investors still believe in US exceptionalism, will it survive the transformation of our times? And what are the alternatives to US assets? More with Rahul Ghosh from Rowe Price and Mahesh Sethuraman from Saxo.
Breaking news from the Business Times podcast team.
Hi guys, this is Emily Liu, your host of Market Focus Daily. I've got some great news. Come July, Market Focus is getting bigger. I'll be bringing in market and investment experts into the studio to share analysis and opinions on what moved the markets and what to look out for in the week ahead. Every Friday, starting on July 4th.
Look out for Market Focus Weekly from the Business Times or wherever you get your podcasts.
And now, back to Money Hacks from the Business Times.
Welcome back, and let's get into it. If US exceptionalism is being talked about again and now questioned, where can retail investors go then?
As someone who lives in this economy, you should be prepared for the fact that your job could be at risk in the future. And if that happens, what do you do? How do you plan for a period of, let's say, lower cash flow? Do you have sufficient rainy day fund? Have you upskilled yourself? Let's say if some of the jobs are not there anymore in the future, what are the kind of jobs that we are likely to get? If we have to pivot away from the US, where are the jobs going to come from? Is it semiconductor? Is it medical? Is it automation? We don't know. So upskilling ourselves, saving for the rainy day is probably the first thing. Then comes the investment. For people who are comfortable with their job, but they're worried about their investment. It's a bit like climate change. We're all worried about climate change, but we cannot make any decisions overnight. Like tomorrow, I'm not going to eat avocado because it gets exported from Mexico, for instance. Those are not decisions that's going to make a massive dent. But we have to change our lifestyle. We have to change the way we travel. We have to change the way we live and so on.
Whoa, a wake-up call for those heavy in US assets. But the supposed end of American exceptionalism sounds more like an argument for diversification into non-US stocks, bonds, and currencies. And diversification has always been something all investors should be into, right?
Now, no one is saying you can't invest in the US. We just saw, right? NVIDIA hit 4 trillion market cap. But there are companies in Europe that are also very important in the entire AI story. There are companies in defense. There are companies in Asia and Europe that are providing the critical infrastructure for building data centers. So I think once investors realize that there are different ways to play the growth that's happening in these global trends, not all of them are in the US. Once investors also realize that perhaps you do need to think about having a diversified currency base, whether it's in euros, in gold, etc., I think that is really what people have to keep in mind. Diversification is arguably much more important today than it was over the last 5 to 6 years because of these factors that I mentioned. Diversification, I want to be clear. When I'm talking about the US, you can look at the difference between big cap tech and the rest of the market, right? Big cap tech has earned its space. But when you look at the rest of the US market, they haven't really grown their earnings that much faster than the rest of the world. But they're still trading at a multiple premium of between 20 to 30%, depending on when you look at it. When you think about other geographies, think about where money is being spent and on what, or what are the trends.
Trump and the trade war poses certain risks, but that does not negate a lot of the inherent advantages that have helped them over the last 150 years. So to kind of step out of the US at this time is also to kind of actively forego a lot of the upside that's going to come from it. My advice would be to not react too quickly, too strongly to this. but have a game plan. If you've already invested a certain amount of your net worth, what are you going to do for the incremental investment? Can you go somewhere else? Is there value in China? Sure, there is absolutely value in China, right? You have a lot of concerns about Chinese economic growth, about deflation, about consumer confidence. But having said that, purely from an investing perspective, it's available at a much better valuation as compared to the rest of the world.
So the big question remains, diversify into what? Where are the opportunities? How much should we put in? And how long should we hold them for? Here's Mahesh from Saxo again.
China is an obvious candidate. As much as China's growth is a problem, it's still growing at close to 5%. That's phenomenal for an economy of that size. And the domestic consumption growth has a long way to go. Sure, it's going to be a very patient play. But then if US is expensive and US is dangerous, where else do you go? Obviously China. And moving on to Europe, right now, Polish markets, for instance, is doing well. And there are pockets in Europe which are definitely doing well. Having said that, the structural issues for Europe remains. Their growth is anemic. Their budget balances outside of Germany are out of whack, not sustainable. It's a union of countries, so they cannot decide as quickly as a single country does. They cannot act as fast as a single country does.
We talk about two big trends in the world today that we can see happening. One is obviously AI. Another is what's happening with weight loss drugs and movement towards health. In AI, you can invest across the AI space, not just in big cap tech. There are good alternatives and companies in Europe. When you look at what's happening in China and the way they're diffusing AI, whether it's through the likes of Tencent, etc., there are ways you can invest there. When you think about all the companies and the infrastructure required to build data centers, the copper, the cabling, etc., some of your best companies in automation, in robotics, are listed in Japan. There are global reasons and global ways to access what are some very powerful secular trends. You think about weight loss. Everyone talks about Eli Lilly, but we tend to forget that the number one competitor is Novo Nordisk, situated out of Denmark. And then coming one rung below, I guess, developed markets, there are still some very vibrant economies in Asia and the Asia Pacific. And while they may be relatively small, you think about the way the Indian economy has grown, Indonesia, Vietnam, etc., because of the fact, whether it's in the US or outside the US, people are looking for ways to access different types of manufacturing technologies, skills, and labor that don't put you under the scrutiny of the US administration.
Takeaway order Money Hacks 231 is ready. As US exceptionalism faces scrutiny, the once unquestioned dominance of US equities is being challenged. Diversifying into non-US stocks, bonds, and currencies mitigates risks and unlocks opportunities in burgeoning economies like China and India and innovative sectors in Europe and Japan. Maybe it's time to move beyond the Magnificent Seven's shadow. A big thank you to Rahul Ghosh from Rowe Price and Mahesh Sethuraman from Saxo. I'm Howie Lim, and this has been Money Hacks by the Business Times.
This is a podcast by the Business Times. Find more BT podcasts at businesstimes.com.sg/podcasts or wherever you get your podcasts. This podcast is meant to provide general information only. SPH Media accepts no liability for loss arising from any reliance on the podcast or use of third parties' products and services. Please consult professional advisors for independent advice.